Good morning, everybody. Hey, welcome to Thursday. It is September 21st. I hope things are going well for you. Yesterday, not such a good day on Wall Street. We'll talk about that and more with Dave in just a second. Before we do that, though, let's not forget that there are so many things in this world that you and we cannot control. However, you can take some control of your retirement portfolio by knowing how much risk you have because you can control the risk in your portfolio. You need to know what that risk is and what it should be based on your age, how close you are to retirement, and your risk tolerance. That's exactly why I developed the core retirement design. Give us a call, 863-382-0037. Hey, with that, got Dave coming up next.
We're at 8:41. It's 19 before 9. Let's go find out what Jay Powell's doing to your money this morning. It's not the stock market, it's the Federal Reserve, because that was the big news yesterday. Downtown Sebring we go to the offices of Statler Financial Services, where Phillip Statler is also scratching his head this morning. Phillip, good morning. How are you?
Hey, good morning, Dave. Doing well. Glad to be here today. It is, I don't understand. They left the markets the same. I mean, the interest rates the same, and the markets decide to tank. I just, it's a little stressful when that happens.
Yeah, I was kind of watching the day charts as it hit 2 p.m. They made the announcement that the Federal Reserve was going to hold off raising interest rates for another meeting. Everything stays steady, and at 2 o'clock we started a nice upward tinge, gained some substantial ground in the blue chips until 2:30 when Chairman Jay Powell opened his fat yap and said that, we're going to keep tight money policies going for the foreseeable future, and it's pretty well a lead pipe cinch that we're going to have to raise interest rates one more time during 2023, and since there's only one meeting left in November, I think it sounds pretty obvious. And starting on the 2:30 press conference from about his first words, let me see here. It looks like the Dow fell by about 300 points inside of about 25 minutes. I'd say that was not a vote of confidence, wouldn't you?
Yeah, I think that probably that word will have to keep interest rates high for a longer period of time was detrimental to the markets because the anticipation was that, we would raise interest rates probably one more time this year. I mean, I think that was a given, but I think the anticipation is that by probably third or fourth quarter next year that we could actually start to see some easing in interest rates. But for him to push out and say, no, we're looking probably 2025, maybe even 2026. I mean, that's an extended period of high interest rates.
And I've got a few real estate friends that are looking at that and going, oh, my Lord, maybe I better start looking at a burger flipping job because we keep those mortgage rates up at 7.5%. Even eventually around here, it's going to end up starting to pinch a little bit. And as hot as our real estate market is, that's going a piece, I think.
I do. I think that is, it's longer than anybody, I think, actually anticipated. And I know it's more than I anticipated. Like I said, felt like that we should get through this. And by the third or fourth quarter next year, we should start seeing quarter point declines.
And that was kind of what they'd been telegraphing too, first part of the year. That fake phone call that Powell got pinched by, but he kind of gave us a roadmap as to what he had in mind at the beginning of the year. Was we were looking at a few more interest rate increases. Yeah, I expected it, and then he was saying, yeah, we can see the rates dropping again toward the end of the year. Okay, fine, things stayed hotter. I think folks were probably baking in the notion it was going to be 24 before we saw any easing of the money supply. But now they're talking about, some of my columnists are saying it's going to be 26 before we see a decrease in interest rates. And I'm kind of thinking right now, the good news is they actually used the term soft landing yesterday, but it's almost like, yeah, we got a soft landing coming, so let's see what happens if we don't put the landing gear down.
Yeah, because they also mentioned in that report they're going to continue, and they are continuing, which I knew they would, to take money out of the money supply. So they're selling off their bonds and taking money out of the money supply, which is still a way of monetary policy in order to slow down the economy.
That's true, and we haven't mentioned that recently. Their divesting of their balance sheet assets has been continuing throughout this time while they've been raising interest rates. So just because they pause for a month, which they've done a couple of times this year now, it doesn't mean that we're not accelerating our tight money policies, because we're taking money out of the market pretty much every doggone day as the Fed sells a few more $1 million worth of bonds and mortgages.
Yeah, exactly. And so that will continue to have an effect.
So by and large, yours and my low opinion of the Federal Reserve pretty much got reinforced after two, but before the end of the market yesterday, and evidently the equity markets appeared to agree to that, and kind of gives us a herky-jerky beginning for this morning as well as we look at it. And it's not getting improved any by seeing more resolution of the picture that maybe, I hate to say it, we might even need another bump, because the unemployment picture at this moment in time looks almost overheated. First-time jobless claims down to the lowest number we've had since January, only 201,000 first-time jobless claims last week, and the number of continuing claims also down to a darn near a multi-year low, only 1.66 million continuing jobless claims in the country. The employment market in the country is, well, very healthy, I'd say.
Well, at least it looks that way. We still have
macro-wise, anyway.
Macro-wise, yeah. But they continue to put. I mean, like you and I talked before we went on air. If the Fed had got this report, they may have changed things yesterday.
That was kind of what went through my mind when we first started on the phone before we went on the air. My first reaction was, boy, I sure am glad this report came out after the Fed meeting.
Yeah, exactly. So, and we're talking about interest rates too. I did want to mention this because it hit my news ticker. This is the first time in like 14 meetings that the Bank of England did not raise interest rates either yesterday.
That's interesting, because the European Central Bank did raise their interest rates a week or two ago, which we kind of saw as a harbinger, as a possibility that the Fed would change their mind and do ours. The fact that the Bank of England is, well, they aren't loosening yet, but they aren't tightening anymore. That kind of gives the communication from across the pond, at the very least, it's time to slow down, guys.
Yeah, hopefully so. Hopefully yeah, everybody will get the same broad strokes anyway.
Which would be nice. So we kind of alluded to the fact that it's kind of messing with the futures this morning. Looking for some good news out there, and we're actually finding it on companies that are reporting their quarterly numbers. FedEx, I gather, really kind of kicked booty last quarter, didn't they?
They did. It was the first quarter of their fiscal year, and they really topped expectations. I mean, their earnings came in at $4.55 versus a $3.71 that was expected. Now, I will say that their revenue was slightly below expectations. Not hurting their stock this morning, though. It's actually up 4.8% this morning.
Now, that's a nice rise, especially when I look at what's happening on the indexes. Kind of means there's some other companies that didn't do quite so good.
Yeah. We have we've talked about real estate and how, home builders are having a little bit of stressful time now. And KB Homes reported, and their stock is falling this morning, even though they beat expectations for their third quarter. They came in at $1.80 a share on almost $1.6 billion compared to the expectation of $1.43 on 1.5 billion. So they really had a good quarter. But it's all in what's the expectation, right? And the expectation is that their gross margins are going to really start to shrink in this fourth quarter. And so it has KB Homes actually down 4.3% this morning.
Kind of offsets FedEx by a little bit. Got another one today?
I do. I have Darden Restaurants reported for their quarter, and they came in and beat expectations as well. And this is their first fiscal quarter. But their outlook was okay. But they're still same-store sales shrunk by 2.8%. And so that's putting some pressure. Well, it was putting pressure early. It's flipped around now, up 0.7%. So good for them.
I had a couple of tidbits that I found in the process, kind of bouncing off of that guidance report from Dart, and Dollar General got downgraded this morning on some guidance they put out saying they see low-income shoppers, quote and unquote, acting recessionary. And if Dollar General feels that you kind of got a picture of the places like Olive Garden that get the discretionary stuff in, yep, they got some challenges ahead, don't they?
Yeah, they really do. Starbucks came out and they raised their dividend by 7.5%. They didn't really talk about earnings much in this report I'm looking at, but they did open a $220 million distribution and manufacturing facility in China. And so they were trading down early this morning, but well, they still are. They're down about 0.5% right now.
I love it. I can't afford to buy a home, but by God, a $5 cup of coffee, I'm up. The world is a weird place, Philip. Resetting the table, it was not a happy response to the Federal Reserve yesterday, and we ended up with some red ink 45 minutes before we opened this morning. What are we looking at?
Dave, it looks to me like we're going to continue to follow that theme this morning. We've got the Dow down over 0.6%. S&P 500 is getting close to 1%. It's down 0.9% right now. And the NASDAQ 100 leading the crew down 1.3%. So nothing good on the indexes this morning. On the other side, it's hard to find anything good either. Silver's down a whopping 3.1%. To just barely over $23, $23.09 an ounce right now. Gold's not much better. It's down 1.7%. And then we've got crude oil trading the wrong direction, Dave, up 0.25%, still down below 90 though, at $89.84 a barrel right now.
I never thought I'd be happy to see crude oil at just under $90 a barrel. Overseas markets kind of react like you expect. The Asian Rim market kind of depends upon us for trade, and tight money here isn't good news there. So at 6 this morning, the Asian Rim all down, some of them down considerably, like Hong Kong over 1.25%. Europe following our futures and saying, we got some reasonably precipitous drops over there too. The Italian markets are down by the better part of 2%. United Kingdom down by about 0.5%. Everybody else kind of falls in between that halfway through the European trading day. If this all scares you, you probably have too much risk in your retirement plans. Time to get a better plan. How do I find you to get that plan, Philip?
Then give us a call at 863-382-0037 to schedule their core retirement design, where we'll help them design that retirement they always dreamed of. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730 and 95.3 FM.
And you and Doug tomorrow morning here, because I'm going to take the day off and see whether or not any classmates that look as bad as I do.
Hey, have a good trip, and I will talk to you soon.
Thank you much. I'll catch you next week. It's 105.7 Light FM and Statler Financial Services. Phillip Statler.
Hey, folks, again, I want to thank you for joining us today. Hope your week is going well. Join me tomorrow again as we talk about what's happening in the marketplace and how you can be prepared. That's coming up tomorrow. Have a great day. Talk to you then.